Okay, that we are a small firm and we want to enter this market that's currently being supported by a monopolist, right? He's the only one selling this good. Now, the monopolist, as a monopoly, is charging a really high price. And we do our math and we say, well, if we enter this market, um, we could make some profit if we charge less money than the monopolist. But what is the problem with that? We're starting to consider not just the profit. Of course, if we go into a market and we charge a lower price, we're going to be able to make a nice bit of profit. The first thing we have to think about are production costs and economies of scale. Can the monopolist, if we don't know what their production costs are, then we don't know how low this monopoly is willing to set their prices to, right? We know that they don't want to set their prices below their average variable cost. But if we don't know what that is, and we're going in with a higher production cost, it is very likely that the monopolist is just going to drop his prices so that it's below ours. So then all the customers will still go with a monopolist because he's offering them lower prices. He's going to put us, the small firm, out of business and then continue acting as a monopoly, right? So we have to think about whether the monopolist is going to be willing to slash his prices just to get us out of that market, to keep being a monopoly. So that's what we should be thinking about if we're thinking about entering the market of a monopolist.